Hi, I'm John Darer, and today we're going to be talking settlements, specifically structured settlements. What is a structured settlement? A structured settlement is a negotiated stream of periodic payments paid as damages in exchange for release of liability that is customized to the needs of a particular plaintiff. Imagine a structured settlement as a river of income, or a job that you cannot be fired from, or a job that you cannot be laid off from during an economic crisis. A structured settlement is a core personal injury settlement planning tool. Why? Because certain sells. And that's the case when interest rates are high, and this may surprise you when interest rates are low. You know, a lump sum can be very hard to manage for many people. The inevitable question of lump sum or structured settlement is one faced by many plaintiffs. It can come up at mediation or when the case settles. However, it's not an either or answer because many times both a structured settlement and a lump sum is the answer. A lump sum can be difficult to manage if you need income. There are many things that come into play, such as how much stable income you need, how long you need the income for, whether it's a certain number of years, for your lifetime, or perhaps even the lifetime of you and a partner or spouse, the timing of withdrawals, the return on investment, the adequacy of reserves and liquidity for unexpected events, the tendency to make impulsive purchases or decisions about money, financial psychology, and how about this? People coming at you to borrow money that they never pay back. I'd like you to consider this image, which illustrates the dilemma faced by someone with a lump sum of cash. What is the safe level of spending? How should the money be invested? How do I feel about risk and volatility? What is a safe level of income to draw down from the lump sum to make sure that it does not run out before you do? Emotions come into play, magnified by the reality that those funds were derived from a physical injury or sickness or the wrongful death of a loved one. A structured settlement, as I said, is a core personal injury settlement planning tool. A structured settlement is an important financial planning tool available to parties in personal injury, wrongful death litigation, and workers' compensation claims that provides essential income stability and precision with tax advantages. Protect your recovery with a structured settlement and create or augment a stable financial core. When the settlement of claims represent payment of damages for physical injury, personal physical injury, or physical sickness, wrongful death, workers' compensation, and the settlement is structured using a qualified funding asset, typically a single premium structured settlement annuity, or a trust fund that invests only in obligations of the United States government, the periodic payments are tax-free. Market-based structured settlements are another option to consider for those looking for growth with discretionary settlement dollars and are willing to tolerate market risk. Ethical use of periodic payments may actually facilitate settlement. A structured settlement, if ethically and effectively used, is an innovative negotiating and settlement planning tool that provides significant benefits to all parties in litigation and may help parties to facilitate settlement. Structured settlement payments for many types of cases are tax-free as the result of these sections of the Internal Revenue Code. By agreeing to a structured settlement as part of their claim or lawsuit recovery, claimants or plaintiffs can receive future payments income tax-free if their periodic payments qualify under Section 104A1 as amounts received under Workers' Compensation Acts or as compensation for personal injuries or sickness, or of the amount of any damages other than punitive damages received whether by suit or agreement, and whether as a lump sum or as periodic payments on account of personal physical injuries or physical sickness under Section 104A2 of the Internal Revenue Code. Taxable damages can also be structured, but those payments are tax deferred, not tax exempt. In such cases, the tax will be due in the tax year that the payments are actually received. So how do you actually get a structured settlement? What do you need to qualify? First of all, a structured settlement is not available to everyone. You must be a plaintiff or claimant. You have to be a plaintiff in a lawsuit, or you have to be a claimant if there is no suit. There must be a direct or a derivative claim for damages. It's also possible for plaintiffs or claimants' attorneys to defer their contingent fees using structured settlements. Structured settlements are available in all 50 states, although a few more choices are available outside of the state of New York. A structured settlement can be offered by the defendant or its insurer, or the plaintiff may actually ask for a structure, but the parties must agree on the terms of settlement. A cardinal rule is that constructive or actual receipt of settlement proceeds must not have occurred. Be mindful of signing a release that does not specify the structured settlement payments or includes the words receipt of which is hereby acknowledged, because it can be fatal to the structured settlement. Feel free to reach out to me to explore whether or not a fixed or market-based structured settlement is right for you. I can be reached at the number below. I'm John Darrer. Thank you very much for watching, and have a great day.